during the event here, but type your questions and comments into the question box on the right side panel so that you won't forget them. And then when we get to the Q&A period, I'll be happy to go into there and pull them out and answer them for you. I also love it when folks raise their hand and talk live online, because that gives us a chance for a little interplay and actually to peel down the question sometimes another layer or two, so we can get underneath the question itself and see what the causes and solutions might be that might present that challenge. Unanswered questions, no problem. Just send me an email at question, singular, question at bizarrefinancing.com, and I'll be happy to answer it for you. All right. How to decide what business to buy. Well, first thing is know what you are buying, and it's not what you think it is. Okay. Know what you are buying. What you are buying when you buy a business, you are buying a leverage machine. I don't care what industry it's in, what customers you serve, you are buying a leverage machine. And understanding that is understanding how to put value on your business, because to the extent it can leverage your abilities and leverage those abilities that you have to an astronomical proportion, then you can be successful. If you're one-on-one, you're like a street singer standing on a corner waiting for people to drop pennies into your cup. On the other hand, once you can leverage yourself as singers do today, you've got electronic leverage that blows you out to millions of people. Now you can make some serious money, right? So you are buying a leverage machine. This is so you don't have to stand on a corner with people putting pennies in your cup. So the concept of that is almost number one in importance, is to have that concept about what you're buying. You're buying a vehicle through which you can leverage other people's money, electronic leverage, people leverage. You're going to have employees, you're going to work for them and you're going to pay them X, and you're going to bill them out or organize that their productivity is worth 2X, 3X, 4X, 10X to you. Okay. You're going to have position leverage, that you're in a marketplace where you can leverage your enterprise to a higher level because of certain things that you've done to equip your business with a higher level of competitiveness. So that's the first thing. Know what you're buying. Second thing is to ask this question, among others, but this is the question I want you to think about. Is it the type of business you would like to own and run? Okay. So the first thing, you know what you're buying, but now is this particular business a one that you would like to own and run? And what does that mean? It means, can you see yourself running this business for many years into the future? Because if you can't, you shouldn't buy it. It's not probably going to be a happy experience for you. This is something where you have to see yourself in that picture when you're looking at this particular business. Will I enjoy it? Okay. Are you going to enjoy this business? Because if you don't, chances are you're not going to be very good at it. So that's probably a key to the next question. Will I be good at it? And do I have the right competency, skill sets, experience to run that business? Okay. If you can answer all of these questions in an affirmative, then the chances are you're targeting into something that could be a good business for you. But I don't care how good it is, unless you're one of these people who just are so money maniacal that you don't care what it is, as long as it makes a lot of money. Maybe you could pull that off. But most people I know can't. They can do it with a high level of expertise once it's in a field that they really love and feel good about and very knowledgeable in. Okay, next. Is the business owned by a flexible seller? Now, you notice we haven't really talked a lot about this business yet, because see, if the business isn't positioned right, you're probably not going to be able to buy it right. So that's why we're covering a number of these things. So one of the questions we want to know, or areas we want to address, is the business owned by a flexible seller? Test one. How many years has the company been on the market? And this is going to surprise many of you, but look for established companies on the market for at least 4 years. A lot of times I say that to people, they say, oh, wait a minute, a business has been on the market 4 years, probably a terrible business, or somebody would have bought it. No. What happens is it takes 4 years for many sellers to get flexible with respect to price and terms on their business, because they start out, they list the business for sale. They think that their child, their business that they groomed and built for the last 20 years is worth gold. And after all, they built it so that they could sell it and retire someday on this great sale price that they were going to get. It takes 3 to 4 years minimum for them getting incredible amounts of laughing at nose before they start to think, maybe this business isn't what I thought it was worth. Maybe I ought to get more flexible. Maybe I need to be more realistic. And so you're going to have an easier time finding a flexible seller if you're looking for businesses where one of your criteria is that they've been on the market for at least 4 years. And sometimes they go on the market, then they come off the market, they go on the market. So you're interested for the total number of years that seller has been thinking about selling that business and actually been serious enough about it to have listed it over that length of time, whether it's been on or off. You don't worry about that. Just what was the starting date of listing and what is it today? But that's an important concept because it'll screen out a lot of the non-flexible sellers. Test two is why are they selling? And there's a lot of answers that you're looking for. These are some of your preferred reasons. You want a business that the owner is retiring. Maybe he's in the middle of a divorce, and so the pressure's really on to get it sold. Having disagreements with a partner or two, they can't get along. The only way to resolve it, sell the business. Other more profitable businesses that they may own, and they're starting to think, wait, if I can redeploy the assets I have tied up in this business, sell it, get my cash, invest that in my more profitable business, that would work out well for me. All of these businesses, all of these reasons rather, have one thing in common in that most often that these are not a reason for selling a bad business. There are reasons why a good business, profitable, growing, all of the good stuff might be for sale, as opposed to red flag reasons, which include, and here the list is almost endless, but maybe there's a lot of that company that's dealing with obsolescence in its equipment or if it's product or if it's systems. There are changes in the marketplace that are adversely affecting them. The product is now being made in India and it's coming in at a fraction of what their costs are. The loss of a key employee who was their top sales manager, he's gone and nobody else can sell like they did. Massive expenditures required to stay competitive. Their equipment's getting old. They don't have enough inventory space. So there's massive expenditures that are required to stay competitive. Unfavorable legislation, either getting legislated or regulated out of existence. And they want to get rid of the business or they have to close the business. And I'm not being facetious here. I may be a little over the top, but you get the concept and it's real. They got labor problems. There's a union trying to unionize their business and they don't want to deal with that. And whoever does deal with it is going to have some serious issues that the original business doesn't have. Why are they selling? And the key here, though, is you want a flexible seller that isn't selling for the wrong reason. Okay, so that's what you're looking for here. I forgot this one, lease expiration, not being renewed. So they can't stay where they are and they don't know where else to put the business. Or if they put the business someplace else, they'll be removed from their market. So all of these things like really key. Okay, is it a sound business? This is number 4. So is it a sound business? Okay, you want to know that it is, otherwise why buy it? Do they have credible financial information readily available? Sometimes you talk to a seller and they'll tell you, we don't keep good records. We have QuickBook financial statements kept by our bookkeeper, but we can't really attest to how accurate they are. We just keep them so we have a general idea of what the business is doing, or we don't even have that. We have some hand scratch sheets that tell us how well we're doing. So you got to know you're going to deal with credible information, and whatever you get from the seller isn't necessarily credible. In other words, did they have their statements produced by an accounting firm? Okay, anyway, a CPA. Okay, so did they have that? And the reason that you want to know that is there are, basically 3 kinds of financial statements that CPAs do. Okay, and one of them is called a review statement, which is basically worthless. It's no different than getting the statement from the seller himself. That's the lowest level of valued financial statement. The next up is a reviewed statement, and that's where the accounting letter at the front of the statement will assert that the CPA has reviewed the financials. They've run some very minor tests against the data, and you don't really have any real confidence that those numbers do not contain inaccuracies or misstatements, even though they've been reviewed by the attorney. And then the final level is an audited statement, which means now the CPA is putting their name on it and saying, we've not only reviewed the statement, we've audited it. We've tested all the numbers. We've done all of the surveys and tests and everything that we can tell you these numbers are realistic in terms of accounting, in terms of accepted accounting principles, that these numbers are accurate. So that's the only statement that you can really look at with some degree of reliability. And as you're looking at smaller businesses, chances are they're not going to have that. Bigger businesses will. Do they have a data room in place? Now, this is an important thing because if the business is handled by a broker, one of the things that justifies the broker's fee is their ability to help the seller organize all of their financial information and to collect it, put it into a digitized data room that once you sign your NDAs, they can allow you to go into that data room and see the financial statements back for several years, accounts receivable aging reports, anything and everything that would bear on your ability to know what's going on in that business should be in there. So your job gets a lot easier if they have that data room. You can get right in there and see it. If they don't, then you've got to rely on the seller to physically provide it to you. They can send it as attachment to emails or wherever they're going to do it. It's a little harder to get it all together. This is one of the values, by the way, of a business broker, is they will usually, if they're professional, take the time to do that. So after signing an NDA, you're going to get the last 3 years of balance sheets, profit and loss statements, tax returns, and then you want the latest month or quarter balance sheets, profit and loss statements. So, you know, really very recently what they're up to, not just at the last year end. And then the question there is be sure you know how to evaluate the company's financials. A lot of people look at that and they don't know how to read a financial statement. So they'll look at it and they'll say, a company shows it's making a profit, shows it's making sales, and sales show increasing year to year. If I take each year and compare it to the prior year, they're selling more, their profits are going up. And then you start to look, what's their margin of profit? Is that stable? Are they making the same percentage profit on their sales? Or is that margin shrinking or it is expanding? So from financial statements, you can start to learn a lot about the company, but you have to know how to look at them and how to evaluate them. Now, today, we're not going to get into that because that's not the purpose of today. Purpose of today is to give you literally a checklist that when you contemplate going into a business and as you're searching for them, these are the things you want to check off as you're looking for and finding these companies. And any place that doesn't come up to what we're saying here, it should create a question in your mind as to maybe this is a business that I might not want to pursue. Okay. Does the business come with management in place? This is all part of, is it a sound business? Because if the management isn't going to stay with the business, you're not going to be buying the same business. If they're leaving, that may be one of the reasons that they're selling. Now, if it's the owner that's managing the business, what do you know about them? Well, management is leaving, right? Because the seller's going to sell the business to you and you got to step into his shoes or her shoes and you've got to run the business. And maybe you're going to run it as good as they did and those numbers will be meaningful. Or maybe you're not. You don't know. You hope. All right. You got to know what's happening to that management. Because you could have a sound business from the past become an unsound business in the future if the management isn't staying there. Okay. That's a real key element of it. Okay. Are the business purchase and operations leverageable? Remember how we started this out? We started this out with saying you're buying a leverage machine. That's the whole purpose of a business. So you're not standing on a street corner waving your arms to passerbys trying to make money. Okay. It has a place in the marketplace, but more importantly, how does that business get leveraged so that you make $1, not a dollar and a quarter, but how do you make $1, $5, $10, $20? That's the idea of the business. And so can you leverage the purchase of the business to start with? And then what about the operations? Are they leverageable? So let's look into that a little bit here. Can you leverage the purchase using other people's capital? Okay. And you don't want to use all your own money. You want to make $10 of your money be $500 of other people's money to buy the business so that you're putting up a very small amount of what it takes to buy the company. Is the seller willing to provide financing for the purchase? Take back a note for that purchase. If they're not, they're probably not a flexible seller because at a certain point, the seller's going to realize that the only way he's going to get the price for his business is to agree to seller financing for a portion of it and perhaps reasonable terms for that seller financing. You want to be sure that you can use other types of lenders to leverage their capital, like asset-based lenders. Is there assumability of the company's debt? So the company may owe money, and one of the ways you leverage the purchase is you deduct the liabilities from the purchase price, and then you assume them. So that's cash that you don't have to come up with to meet the purchase price of the company. Outside investors. Is this company sexy enough and interesting enough and potentially profitable enough that outside investors will want to invest in the company, enabling you to use investor dollars to buy it and operate it? And then, of course, there's friends and family. Are they willing to put money in behind you in this company? Just some idea of where these funds can come from that give you leverage to your capital, leverage to your dollars. Going further along here, what is the business model and pricing? All part of this number 5. What is the business model and pricing? Okay, what does that look like? Is the business scalable? Is this business have very limited growth capability? And does it lend itself to a structure that can be organized into standards, procedures, replicatable methods of running the company, ways to minimize employees or make them more efficient? In other words, how is this business growable and what would it take to do it? You want to have a sense of that. Is it already scaled for growth or do you have to do it? There's a big difference in the value of a business if it's already scaled for growth. Now all you have to do is operate it as a scaled leverage machine, or it's not. And you got to do it and you don't know how to do it, which should be a real problem if you're going to take that business over and you want to grow. Does it have strong margins? Okay. Businesses that don't have strong margins are very hard to grow. They require massive amounts of capital to move a very little bit. So the stronger your margins, the bigger the gap between what it costs you to buy your services that you're going to sell or your products that you're going to deliver relative to the sale price, the easier it's going to be to grow the business. If you're having to eat things out in very narrow margins, that's a tough road and you need a lot of capital if you're going to do that. Does it market and sell its products or services? It's just an internet business. They just sell it direct off the internet. Do they sell through distributors? Do they sell direct to stores? Anyway, how do they sell? Okay. How do they market? How do they sell their product? A business that is thriving and growing on the internet, for example, and it's selling direct from its own manufacturing to consumers, probably has a huge margin in there. And if they've been effective at selling through the internet and they've used relatively few dollars to build a very big sales base, then that's probably a pretty business model for that type of business. Now you may have your own idea about taking this company and adding a different business model to it that you feel you can make it more successful, but you're not buying your addition. You're buying what exists. And so as long as you only pay for what exists and then you add yours later, then you're doing a good thing. But if you have this anticipation, I can do this with this business model, and then you pay the seller because of all the opportunity and potential, you're overpaying for the business. You don't pay the seller for what you're going to add. Can needed assets be financed? Okay. So if you need to grow the business, you want to be sure that whatever assets you need to enable your additional growth, that they can be financed. Otherwise, you don't have leverage. You've got to pay the cash for them. And now that cash is always going to be somewhat hard to come by. That's the nature of business. Cash profits aren't always easy. Can prices be increased with little or no loss of customers or sales? Now, whenever you take over a business, one of the things you want to look at is the pricing of the products and services. Almost invariably, you will find that most business owners suffer from what's called price timidity. They're timid about raising their prices. They're afraid that they're going to lose customers or sales, and they don't want that repercussion from their customers. And so a lot of times when you buy a business, that's been true of the seller. And you'll see in that business, if you know the marketplace and you're comfortable that they're underpricing their product or service, then you're buying a business that, again, is be interesting because when you do own it, you can increase the prices, increase your margins, and have a more profitable business than you had to pay for when you set up the purchase price with the seller. So that's a really good item for you to have some insight into. If changes are needed, can they be made quickly and inexpensively? Okay. And of course, you're always going to go for what's called the low hanging fruit first. In other words, when you look at the opportunity to buy a business, what changes could you make quickly for not a lot of expense that could have a reasonably disproportionately larger impact on the business so that you can start generating those extra profits as quickly and inexpensively as possible? So these are all part of the things that you're going to put in your analysis of whether this is a good business for you or not. So a sixth item that you want to pay attention to is, what are the growth opportunities for this business? Is it buggy whips and the market keeps shrinking? Or is it the latest tech stuff that they have and is flowing through their sales channels where the stuff is in big demand and as fast as you can build up the company, it's going to grow? Or where the trends in the marketplace are clearly and highly up. Hope that didn't sound too bad there. And are strongly up, so that you know that marketplace is going to pull your growth, that you're not going to have to push your growth. And to me, this is the biggest question that has to do with this, is how can you add value? I wouldn't buy any business, no matter how good of an opportunity it looked, at least at my in place. I wouldn't buy any business that I can't add value to. And the reason is the price that I'm usually going to have to pay for a decent or good and going and growing business is its marketplace or near its marketplace purchase price. And what that means is all the leverage that I do, what I have to pay for a partner or other equity capital, what I have to pay for acquisition financing or debt, those all have big costs. And whatever I'm able to generate from that business that I just purchased, chances are the vast majority of the profitability of the business is going to go to pay down That debt is going to go to pay off the interest costs and the money costs of it. And the key to the value proposition for me of that business is how can I add value to it? Is it because I have a particular expertise? Is it because I have great connections? Is it because I've got an incredible product that I can put right into that business? In other words, what is it that I'm going to do to add value to the company so that after I bought it, it's worth a lot more than it was before? And that the cash flows are stronger, the profits are stronger, and it now makes paying off my purchase debt very easy. Does the business have an expanding marketplace? Of course, it's always more interesting to buy a business that has an expanding marketplace because that's a really good characteristic for growth ability. The marketplace just keeps getting bigger and stronger. And so you taking a bigger and bigger piece of it becomes relatively easy. Is the business competitively positioned in the marketplace? It's yeah, the market might be great, but if location is an issue, they might be in a poor location. Is the business competitively positioned in the marketplace? You may be dealing in the high end of the market, this business that you want to buy, but the high end is relatively static. It's the middle level customers, the customer who's even upper middle class or lower middle class. That's the buyer. But all your products and services are targeted towards the high end of the business, which isn't growing. So where are you in this marketplace? This is like peeling down the onion here of really getting underneath it all and saying, realistically, for this business, are they competitively positioned? Can new product or services be added effectively? And that's a really important question because that may be the source of the added growth of the business once you own the basic business. Are there synergies with another business that you already own or plan to buy? Because that can make this business more profitable to you than an ordinary buyer. And so in the marketplace, it's sold at a price that the average buyer would likely pay for the business. But because of the synergies, you can not only add profitability to the company you just bought, but if the synergies are strong, it because you now own that business, those synergies can add profit to the business that you already own. So you get a double win, which makes the business purchase extraordinarily profitable for you. All right. So next question, number 7, or next item that we want to have is one of our keys to what we're looking at here are what are the key assets and what are the costs to update or upgrade them? All right. So you're coming into a business, it has a certain state of being and it has two types of assets, okay, that you can look at. One are tangible assets. They're things you can taste, touch, and feel. They're the things that are called real assets sometimes, or value is usually ascertainable as opposed to goodwill type of assets and intangible assets, which is it's more subjective. You ask 10 professionals what that's worth, and you'll come up with 10 different prices. But let's take tangible assets first. Okay. You're going to want to look at their website. Is upgrading or updating needed? What would that cost? What about their social media accounts? Is upgrading or updating needed there? What would it cost? Their software that they're using is upgrading or updating needed there. Machinery and equipment, same thing. Okay. I know a lot of businesses that are put on the marketplace because their machinery, while it's still good and still functionable and still is runnable in a way that can make the company profit, it's reaching the edge of its useful life. It's getting close to becoming obsolete. It's getting close to mechanically being too costly to maintain. So that can sometimes be the reason that the seller was selling the business because he doesn't want to make that big capital investment that it's going to take to replace all that stuff in the probably near recent or short-term future. So those are important questions. What about the inventory? Is it current or does it have a lot of old stuff in it that's not really saleable anymore? Or how much of it is actually obsolete? How much new inventory is needed to sustain sales? All important considerations that you are going to undertake when you're looking at whether this is a good business for you to buy or not. Number 7, we're continuing on here. Intangible assets. That's the other group. The owner themselves actually realizes an intangible asset of that business. The reason the business is what it is today is probably because of the knowledge, the experience, the expertise, the contacts, the energy and drive of that owner that built this over those many years. And once you remove that owner from the picture, that very valuable asset is gone. Okay, no way to really put a number on him, but I would say you're going to be missing a lot of value when that owner disappears relative to what the financial statements say the business is worth because you remove that owner. What's the business worth 2, 3 years down the road without him there driving the growth and driving the profits, right? You're going to replace them, but you're still an unknown in this business. Okay. Unless you've had a business like this before. What happened there? Intangible assets. There we go. All right. All right. So unless the business has been professionally managed without input from its seller, okay, the business will be losing its strongest asset. And I think that's the point that I want to convey here. So the value of the past isn't necessarily the value of the future. Will the owner stay on? This is an important factor in this to transition the business to you and then to train you to make sure you know what they know and that you know how to, in effect, run the business at least the way they did. And by the way, you may think you know more about the owner than the owner knows. You may think that you're going to do it better than they did it. You don't do that right away. Usually, what I do is, and at least I did in the past, when I actually was in the position where I needed an owner to stay on and show me that business, I always assumed that they were brilliant. Okay, that the reason the business is what it is because of what they know, even though their knowledge may be a little obsolete because times have changed. But I let them show me and transition to me the business as they ran it. So now I got a clear picture what that's all about. And then I make changes to the business based on my instincts, my knowledge, all of those type of things. But I don't just cancel out what the business has been doing. I make sure that I understand how to manage the business the way it is and then transition it to what I want it to do so I can take measurements of the changes I make and how they change sales and profitability and other key performance indicators so that I know that what I'm doing is really making a difference and that what I'm doing is really positive in its outcome. So another intangible asset is the management of the business. And we discussed that a little bit earlier, but you want to make sure there are people in place to run the business and that they're knowledgeable, they're energetic, they got great work ethic, they have all the things you want your management talent to have. Okay. And then the brand itself doesn't have a way to really put a value on it. Very difficult. But brand is a real thing. Is how does the public think about this business? How does the customers think about this business? And a lot of times, fairly new businesses that are a year or two old will talk about the value of their brand. Well, they don't have a brand yet. Having a brand takes time. Okay. It takes time to imprint on the public what your company stands for and that your company stands for something great that they want to buy from. Okay. And that doesn't happen overnight. So unless you're buying a company that's 10, 15, 20 years old, don't even think about brand. Okay. Unless they've spent an incredible amount of money on building their image. So one of the indicators of some level of brand value is what's their customer base? How many customers do they have that buy repeat businesses that buy repeatedly from them? Not that buy once. Buying once is not a brand. Buying once means you advertise people bought your product and they didn't like you, they didn't like the product, and they don't buy again. Brand is a product of customer base and this thing called loyalty. Okay. And loyalty is a function of lack of turnover. So when you see this big turnover where somebody buys even once or twice or three times and then they disappear forever, that turnover is an indication that the brand of that company is really not that strong. And public image. Okay. How does the public see you? Is your company quoted in news articles all the time about that industry? Are there articles written about it? Are there things that the industry acknowledges that company does really well? If you were to talk to various charities in town, do they think highly of that company? And does the company reproduce an image where people think highly of them because the good deeds they do in the community? Okay, all of those things affect the brand of the company. And there's no way to put a real value on it, but you want to look at it to see if it's positive in terms of your purchasing the company. All right, we're into number 8 here, which is can you get reliable financial information on the company? Can you get reliable financial information? Okay, so the first question you're going to ask here is do they have this data room thing, right? If they can, you can get in there and get your information. So after signing an NDA, you're going to request the latest years of balance sheets, profit and loss statements, tax returns. You want at least 3 years. In the USA, there is no such thing as we don't have financial statements or we don't have tax returns. So anybody that says to you, well, we didn't keep good anything, they have tax returns. If they don't have tax returns, turn around, walk away and never look back. I don't care how good everything else look, because the one party you don't want to have to contend with is the IRS who comes after them because they didn't file tax returns and now you own the business. And I know what you're going to say, you smart guys out there. We're going to say, well, if I do an asset purchase, I don't have to worry about that. I'm just buying the assets of the company and the corporation or LLC itself. They keep that. So if they got a problem with the IRS, it's their problem. If you want to live in that world, God bless you. I would never touch that world. And the reason is there is no organization more powerful in the United States than the IRS. And if they think that seller committed any fraud or anything even close to that, didn't file tax returns, and now they've been able to assess a lot of money against that company, they will come after those assets. And they'll make you prove that you are entitled to those assets without their lien, without their claim. And the amount of money you will spend fighting the IRS, even if you're right, will be astronomical. Okay. And remember, they get all of their time in court and all of that stuff for free. They slap a lien on your asset. You got to go pay to get it off. The chances are you're not going to get it off. The lien that they put on you, even though you've proven in court that they had no right to it, they were not entitled to it, they never should have put the lien on. The lien will stay on your record. You will try and get it off for years into the future. And maybe someday, after spending tens of thousands of dollars, you'll get the lien off your financial record. So do not go there. Best advice I think I can give. All right. Number 9, ascertain and verify your due diligence. Everything you think you know about the company, trust me, you don't know. The only person who mostly knows is the seller. And there's stuff, frankly, that's even hidden from them because they don't know. They have no clue. And so you need to verify everything as part of this business purchase. To know that you want to buy the company is you got to do the due diligence. So what do you want to track down here? You want to know you've got an absolute handle on what's called TPM, gross revenue and profit. TPM stands for, it says training up there. It should say trailing 12 months gross revenue and profit. The last 12 months. Okay. If you're buying a business based on the year end financial statements, and you're trying to price it and acquire it based on that, and now it's July, you don't know what's happened since December and July. It may have lost business. It may have shrunk. You don't know what it's doing. On the other hand, if you have 12 trailing months of gross revenue and profit, and you know what it's done since last July to this July, you now know what it has done over a 12-month cycle recently. And now when you're comparing it to the past, you want to look at 12 trailing months from the date that your current 12 trailing months started, because you always want to be able to compare year to year. If you're going to buy with truly current financial information, everything's got to get converted to 12 trailing months. All right. So that's basically that. And then TTM is a measurement of the company's financial performance over the most recent 12-month period, which is what you care about. You don't care about their year ends because unless it's January or February, then you're fine. But if it's not within their year end is not within the last couple of months, you're selling yourself short by trying to impute what happened during that more current period. Now you say, okay, I can get quarterly statements. I can get monthly statements. Yes, you can, but one way or another, you're still going to have to track it up to now when you're buying the company and what the year ends look like then you're going to still have to compare those monthly or quarterly statements that you got after the year end to the monthly and quarterly statements from the prior years. Okay. Because unless you're doing all that, you're not really getting the true trend of the earnings of the company. What is the operating profit? Now, some people call that EBITDA. It's not, but it's close enough. Of this business after paying a fair CEO's salary. That's the critical part of the equation. Whether they're selling you the business on a multiple of net operating profit before or after tax, different multiple, or they're selling you the business priced on some multiple of EBITDA, earnings before interest, taxes, depreciation, and amortization. All of those numbers are interesting. The question is, what about the CEO? What about the owner? Was he working in the business? Were they the CEO of the business? Were they taking out a market rate salary, which then showed what the EBITDA was after that CEO's market rate salary was taken out? Or did they pay themselves less? And so the EBITDA is now inflated because that's not the real value of the business. When it has to pay a real live CEO to do the work. So EBITDA is profit or earnings, but it's earnings after all of the labor in the business and management in the business is paid for. If they haven't had a market rate salary for themselves, then you're overpaying because the EBITDA multiple is going to be too high. On the other hand, they may have been paying themselves triple what the CEO would have been paid. And then they're probably going to tell you that and say that the real EBIT of the business is after deducting their overpriced of their salary or whatever they paid themselves, in which case they're reasonably correct. And you just want to be sure you're clear on that and exactly how that's happening. And then still on the same topic here, and this is a term I absolutely hate. Okay. What is the SDE, the seller's discretionary earnings? That is probably the most meaningless number that they will ever throw at you. And they throw it at you because it's designed to impress you with all the money you're going to make out of this business that you're going to be able to put in your pocket. And it just ain't true. Okay, I'll discuss that here and show you why. And that's the question that you're going to have to get at is how much money would I be able to put in my pocket? And it's not that number that they'll give you because it's after keeping enough earnings. What you can put in your pocket is keeping enough earnings in the business to pay interest and amortization on your purchase debt. And you got to pay that. It's not going to go in your pocket. They didn't have to pay it, but you're going to have to pay it. It's not going to go in your pocket. Okay, interest and amortization on the acquired debt. That they probably did pay for, but you're going to have to pay for that too. And they part that was interest. Yes, that reduced what the owner is going to show or should show as seller's discretionary income, but the amortization is not. What the amortization many times ends up back in EBITDA, right? Because it backs out the amortization. So you don't get to put that in your pocket. Okay, not really. And update because amortization is paid for. You pay it. Like when you pay down a bank loan, you're paying interest and then amortized principal. So the principal that you're paying is disappearing, but yet it's not an expense of the company. Okay, it's a loan repayment. It's not an expense that reduces income. All right, update or upgrade the business's aging. Okay, I'm trying to think what that one. It seems like there's a word missing there. Update or upgrade the businesses. Oh, and there's more to come. The business's aging machinery and equipment. Yeah, they're showing depreciation expense, and they're saying you can put that in your pocket as part of seller's discretionary income. But yeah, it's discretionary. But if you as a seller don't put it back into buying the new equipment as the old equipment is depreciating, then you're not going to have a competitive business going forward. It's not money you can take out. It's money you've got to keep reinvesting back in newer and more updated machinery and equipment. Software and systems, they age, they change, they have to be maintained, upgraded. And old software becomes obsolete. Then you got to go out and pay some huge fees to get a new system or a new software in there. Furniture and fixtures. Okay. Same thing as machinery and equipment. They're depreciating, got to be replaced. Reinvesting in the business for growth. Okay. If you're going to grow the business, you can't take money out of the business. Why? Because your payroll is going to get bigger. Okay. In fact, if you look at any business, they have what's called an asset to sales ratio. And you'll see that it's consistent throughout an industry, that ratio. And the reason is in a certain type business, you need a certain amount of assets to support a certain amount of sales. And if you don't have the assets to support the sales, you can't increase the sale without increasing the assets. One supports the other. So payroll is going to go up when you increase your sales. You're going to have to hire more people. You're going to have to employ them. You're going to have to provide them benefits. You're going to have to do all that stuff. Every time you increase your sales, it requires a bigger payroll. It takes money to do that. And usually that payroll gets paid out up front and then the productivity comes later. Okay. So that productivity gap has to get paid for. It's going to require more inventory. So that means more cash going out and stored in some room somewhere where the inventory is getting bigger. The accounts receivable that you carry, have to carry more accounts receivable. So you've got a gap between when you ship the product and then when you actually get paid for the product. And as you're growing in sales, that gap gets bigger. Okay. So you got to have more capital to sustain the accounts receivable. You have to buy more equipment. You get the concept here. You have to have more facilities. So you don't get to take that money. Okay. So you want to be really careful when you're getting all excited about seller's discretionary income because it doesn't mean anything. It means nothing. These are what means something. It's after all of this, what do you get to put in your pocket? Okay. And that's where one of the items that I'm going to cover, what that I've already covered with you is value added. I think I covered it already. This is why when I buy a business, I look at it in terms of, I know where all the money's going to go. It's going to go right here. Okay. So the value of that business to me in the short term is going to be the value I can add the minute I own it. And the less expensive that is and the more it is and the quicker I can do it, then that business is going to start producing money for me out of that, not out of this. Okay. We're still on the same topic here. Number 9, the value of tangible assets. Okay. Inventory. What's that inventory really worth? Okay. This is your due diligence, remember? Okay. So let's go back to inventory here. So I'm sorry. So in terms of inventory, you got to know what's good inventory, what's bad inventory, what's obsolete inventory, what's damaged inventory, what's saleable inventory, and what's not saleable inventory. And that's only done by rolling up your sleeves and getting in there and literally either having an evaluator come in and do it for you or for you to do it yourself. And that's the only way to get that done. The accounts receivable, you hopefully have an accounts receivable aging. You know how much is current, how much is 30 days past due, 60 days past due, 90 days past due, anything 90 days past due, and more is probably worthless. And so you got to figure it that way. But you got to identify them. You got to know what is actually true for those accounts receivable. The same thing is true with FF&E, furniture, fixtures, and equipment. You got to really know what is the value of that. Furniture's worth 10 cents on the dollar, even when it's relatively new. Same thing with fixtures. Business equipment can be very different. In a manufacturing company, you can have equipment that's 10, 15, 20 years old, and it's worth literally as much as the day it was bought, especially if it's been well maintained. So different things are different. You got to have a sense of what are you really getting: vehicles, land, and buildings. And then you need to know the accuracy of the represented liabilities that you are assuming. Now, if the seller agrees to retain those liabilities and pay them off, that's one thing, okay? But a lot of times the way you reduce your purchase price is you assume liabilities. So now the seller doesn't have to pay them. So that's a reduction in the purchase price. And you've leveraged the people whose liabilities you've assumed their money, in effect, for the purchase price of the business, because the seller didn't have to pay them off, and you reduce the purchase price accordingly. That accuracy you want to know. Are there any hidden liabilities? Any hidden liabilities? And those things can show up in what are called retirement plans. A retirement plan is not a fully funded plan, let's say. That employees put in time, they're owed a certain amount of money because of their retirement plan, but the plan hasn't been fully funded. When the person retires, let's say when you own the business, you got to pay them this retirement, but they didn't set aside enough money to pay it. So now you got to pay it. Okay. You got to know when that occurs. You got to know if that's a possibility. Various employee benefit plans, they have a medical plan, and the company's required to pay certain outcomes, pay for certain outcomes, or certain types of things that aren't showing as liabilities on the company's balance sheet. Unreported accounts payable. A lot of times you go into a business, and sellers don't necessarily do this on purpose. It's just sloppy accounting. Okay, they buy something, and it doesn't show up on their accounts payable. And the deal closes, and the item hasn't been paid for. And the next thing you know, the person who sold it to you wants to repossess it, or they're just saying, you got it, you got to pay for it. And now you're in a legal hassle with them, or you're just out the money. In either case, you need to know all this stuff. Now, accountants are pretty good at finding all that stuff if you point their nose in that direction.